The United States government just tipped its hand and almost no one noticed. While investors were distracted by short-term volatility on their screens, staring at charts and debating whether silver had topped, a far more important signal was quietly sent behind the scenes. No announcement, no headline, just a silent adjustment inside a government system that exposed the truth the paper market is trying to hide. For days, the conversation centered on price swings. Traders obsessed over dips, momentum, and technical levels, asking the wrong question. The real question was never where silver traded on paper, but what it would cost to replace it in the real world. And that question was answered not by Wall Street, but by the entity that mints the nation's money. The U.S. Mint did not merely update pricing, it revealed reality. By internally valuing its silver coins at levels that nearly double the visible market price, the government delivered an unspoken admission. The paper price no longer reflects true value. When a sovereign institution prices metal far above the screen, it is not speculation, it is acknowledgement. This is how broken markets expose themselves, not through crashes but through contradictions. When official pricing diverges from exchange pricing, price discovery is no longer functioning. What remains is an illusion maintained by derivatives, leverage, and confidence that has not yet cracked. Governments rarely tell the truth with words, but they always tell it with numbers. This number tells us that the cost of real assets is rising faster than the currency used to measure them. That is not a silver story. That is a currency story. And once that signal is seen, everything else must be reinterpreted. Every dip, every smash, every surge is no longer noise. It is tension between paper claims and physical reality. In the next chapter, we will break down why this gap exists, who it protects, and why it cannot survive. Because when the government and the screen disagree on price, history shows us which one eventually gives way. To understand why this pricing gap exists, you have to understand how silver is priced in the first place. The number you see on your screen is not the price of silver. It is the price of a promise, a futures contract, a derivative, a paper agreement that assumes metal will be available later if someone asks for it. Most of the time, no one does. Contracts are rolled, settled in cash, or quietly offset. The system works only as long as belief remains intact. But physical silver lives in a different universe. It must be mined, refined, transported, insured, stored, and delivered. Every one of those steps has a cost that does not care about algorithms or sentiment. When those costs rise faster than the paper price, a fracture forms. That fracture is what we are witnessing now. On one side of the market are paper traders swapping contracts back and forth, confident they can always settle without touching metal. On the other side are mints, dealers, manufacturers, and sovereign buyers who understand a simple truth. If you actually need silver, you must compete for a finite supply. When those two sides stop agreeing on value, the market stops functioning. This is how a two-tier system is born. In the first tier, silver is cheap, liquid, and abundant as long as no one asks for delivery. In the second tier, silver is scarce, strategic, and expensive because it must be replaced in the real world. The gap between these tiers is not an anomaly. It is a warning. When that gap widens, behavior changes. Holders of physical metal stop selling, liquidity dries up, sellers vanish. The very mechanism the paper market depends on begins to fail, not because of panic, but because of rational self-interest. No one parts with a scarce asset when official pricing tells them it is undervalued. This is why sovereign pricing matters more than headlines. It anchors expectations. It tells physical holders what not to accept, and tells paper traders what they can no longer assume. Once that shift occurs, volatility is no longer random. It becomes directional. In the next chapter, we will examine what happens when this disconnect reaches the vaults themselves, and why price suppression often precedes something far more important than profit. When price manipulation stops working on the screen, it moves into the shadows. This is the stage where most investors lose the plot because the real action no longer happens in public view. It happens in vaults, in warehouse reports, and in inventory movements that almost no one reads. But this is where truth surfaces because metal cannot be faked once it starts leaving the building. When large price smashes appear without follow-through, they are not signals of weakness. They are cover. Sudden downward moves serve a purpose. They create the illusion of abundance at the exact moment physical scarcity is accelerating. This tactic has been used for decades. Lower the paper price, discourage attention, and quietly move real metal while no one is looking. Vault data exposes this game. When millions of ounces disappear in a single session, it is not retail demand. It is not coincidence. It is coordination. Large players do not remove metal impulsively. They act when they believe future availability is at risk. Every ounce pulled from a public vault is an ounce removed from the market's ability to deliver. This is where suppression flips into desperation. The paper market requires confidence that metal exists somewhere available if demanded. Vault withdrawals shatter that confidence. When registered inventory declines rapidly, it signals that owners are removing the for sale sign. They are choosing control over liquidity. This behavior tells us more than any price chart ever could. Institutions do not hoard unless they expect disruption. They do not drain vaults unless they believe replacement will be difficult or impossible. Price weakness paired with inventory collapse is not bearish. It is explosive. This is why paper crashes often precede physical shortages. The goal is not profit, it is acquisition. A lower price allows large withdrawals to be settled more cheaply, while public attention remains focused elsewhere. By the time the data is noticed, the metal is already gone. In the next chapter, we will examine why shrinking registered inventory changes everything, and why once this process begins, it rarely reverses. Registered inventory is the pressure valve of the silver market. It is the portion of metal that is not just stored but explicitly available for delivery against contracts. As long as that inventory exists in sufficient quantity, the paper market can pretend it is stable. Once it begins to drain rapidly, the illusion starts to fracture. When registered silver declines, it does not mean silver is disappearing from the world. It means it is disappearing from the system that promises delivery. That distinction is critical. Metal moving from registered to private storage is metal that no longer answers to futures contracts, clearinghouses, or exchange rules. It becomes again controlled by whoever holds the keys. This is why rapid declines in registered inventory are never accidental. They reflect a collective decision by insiders to remove optionality from the market. The for sale sign comes down, the door quietly closes, and from that moment forward, every outstanding paper claim becomes riskier than the one before it. Markets can survive high prices. They cannot survive unavailable supply. When traders believe delivery is possible, they accept volatility. When delivery becomes uncertain, behavior changes instantly. Shorts hesitate, longs refuse to roll. Contracts stop behaving like instruments and start behaving like liabilities. This is where systemic stress begins. Exchanges are built on the assumption that only a small percentage of contracts will ever demand metal. That assumption collapses the moment confidence in inventory collapses. Once participants suspect that delivery may fail, the rational move is to demand metal early or exit entirely. This is how liquidity vanishes without a crash, not through panic selling but through refusal to participate. Sellers step away, buyers demand terms that cannot be met, spreads widen, volatility increases not because of emotion but because structure is failing. In the next chapter, we will connect this inventory collapse to government behavior and explain why sovereign actors move before markets are allowed to react. Governments always move before markets are allowed to understand what is happening. They have access to information, constraints, and risks that never appear on a trading screen. When a sovereign actor changes behavior, especially around strategic materials, it is rarely reactive. It is preparatory. Silver is not just a monetary metal. It is an industrial input embedded in energy systems, electronics, medical technology, and defense supply chains. When availability tightens, price is no longer the primary concern. Continuity becomes the priority. This is why government pricing decisions matter more than exchange quotes. They reflect replacement risk, not speculative demand. When official channels suspend sales or reprice aggressively, it signals awareness of scarcity. Sovereign institutions cannot afford to sell strategic assets below replacement cost. Doing so would be irrational. The moment they stop participating at paper prices, they reveal where the true floor exists. This creates a feedback loop. Physical holders observe government behavior and adjust their own. Producers delay sales, dealers widen premiums, industrial users secure supply in advance. Each action reduces available float, which further disconnects the paper price from reality. At this stage, the market is no longer debating direction. It is negotiating access. Paper price becomes irrelevant to those who actually need metal. What matters is availability, lead time, and certainty of delivery. Price becomes whatever clears supply. This is where policy risk enters the equation. Export controls, critical material designations, and procurement mandates do not require public announcements to have impact. The mere anticipation of intervention changes incentives. Metal moves from public circulation into strategic reserves long before any rule is written. In the next chapter, we will examine how this sovereign behavior collides with bank positioning, and why leverage turns from advantage into liability when physical supply tightens. Banks dominate the silver market not because they love the metal, but because they control leverage. For decades, derivatives allowed them to sell vast quantities of silver they never intended to deliver. As long as physical supply appeared abundant and confidence remained high, this structure generated easy profit. But leverage only works when the underlying asset is available. When physical supply tightens, leverage becomes a trap. Paper positions multiply risk rather than disperse it. A short position backed by metal is manageable. A short position backed by confidence alone is fatal once that confidence erodes. This is where inventory drain and bank exposure intersect. As metal leaves the system, the collateral behind paper contracts shrinks. Each ounce withdrawn increases the leverage ratio of every remaining claim. Losses accelerate non-linearly. What looked stable suddenly is not. Banks respond predictably. They increase volatility to discourage participation. They engineer sharp drops to trigger stop losses and margin calls. These moves are not signs of control. They are signs of stress. Volatility is the language of a system trying to regain balance it has already lost. At the same time, banks face a contradiction. They need lower prices to reduce mark-to-market losses, but lower prices stimulate physical demand and accelerate withdrawals. Every attempt to suppress price worsens the underlying shortage. The trap tightens. This is why extreme short exposure is dangerous in a physical market. You can print contracts. You cannot print metal. Once physical holders refuse to sell, the exit door narrows. Liquidity vanishes when it is needed most. In the next chapter, we will introduce the third force in this market, the retail public, and explain why their behavior transforms a structural imbalance into a potential breaking point. The retail public is often dismissed as noise, but at critical moments it becomes the catalyst. Unlike institutions, retail investors do not operate on leverage models or quarterly mandates. They operate on belief, fear, and lived experience. When that psychology shifts, it does not reverse easily. For years, silver attracted a niche audience, but something changed. Inflation eroded trust. Currency stability became questionable. And suddenly silver was no longer a speculative trade. It became a statement. Retail buying stopped being reactive and became persistent. Consistency is what matters here. Short bursts of enthusiasm can be absorbed. Sustained accumulation cannot. When retail investors buy continuously, they remove float from circulation, even if they do so imperfectly. Each ounce held outside the trading system is an ounce that cannot be rehypothecated, leased, or quietly reused. This behavior collides directly with bank leverage. Retail demand does not care about margin efficiency. It cares about ownership. That difference is critical. When millions of participants refuse to sell dips, volatility loses its power. Price suppression becomes ineffective. Retail also changes the narrative. Markets run on the stories as much as data. When enough participants believe that paper assets are unsafe and physical assets matter, behavior shifts permanently. Selling becomes betrayal. Holding becomes identity. This is how squeezes evolve, not through sudden spikes, but through stubborn refusal. Each attempt to force prices lower attracts more buyers. Each smash strengthens conviction. The market stops responding the way it used to. In the next chapter, we will examine why paper proxies fail during these moments and why ownership structure determines who survives the repricing. When demand accelerates faster than supply, paper substitutes are introduced to absorb pressure. ETFs, pooled products, and synthetic exposure exist for one reason: to redirect buying away from physical metal. They create the appearance of participation without immediate strain on inventory. Under normal conditions, this works. Paper proxies satisfy investors who want price exposure without storage concerns. But during structural shortages, these vehicles become fault lines. They depend on trust custodianship and the assumption that metal is available if needed. When that assumption weakens, the entire structure becomes fragile. Ownership matters. Holding a claim is not the same as holding metal. In a stress scenario, claims settle. Metal delivers. That distinction defines winners and losers. Cash settlement is not protection when currency itself is under question. As physical silver exits the system, the backing behind paper vehicles thins. Accounting rules and leasing arrangements can delay recognition, but they cannot replace atoms. Eventually, the gap between reported holdings and deliverable inventory becomes impossible to ignore. This is where confidence breaks, not because of headlines, but because redemption becomes inconvenient or restricted. Small frictions escalate into systemic stress. Participants realize that what they own is exposure, not possession. Markets tolerate complexity until simplicity becomes necessary. In a repricing event, simplicity wins. Assets that require explanation lose to assets that require custody. In the next chapter, we will bring all three forces together and examine what happens when sovereign signals, bank leverage, and retail conviction converge at once. When sovereign behavior, bank leverage, and retail conviction collide, markets do not adjust smoothly. They snap. Each force alone creates tension. Together, they remove all remaining slack from the system. At that point, price is no longer negotiated. It is imposed. The sovereign signal sets the floor. Governments cannot afford shortages of strategic materials, so their actions quietly define minimum acceptable value. Banks, meanwhile, are positioned for stability that no longer exists. Their exposure depends on rolling contracts forward in a world where metal stays put. Retail investors apply the final pressure by refusing to release supply back into circulation. This convergence creates a deadlock. Paper claims expand while physical availability contracts. The mismatch grows until it overwhelms the mechanisms designed to hide it. Spreads widen, volatility increases, liquidity evaporates at the worst possible moment. At this stage, repricing is not a bullish thesis. It is a mechanical necessity. The market must rise to a level where selling resumes production is incentivized and inventory returns. Until that happens, pressure continues to build. This is why repricing events feel violent. They are not driven by optimism, but by constraint. The market is forced upward to restore balance, not to reward speculation. Those who understand this act early. Those who wait are carried. In the final chapter, we will step back and translate this analysis into strategy. We will discuss lessons, risk management, and how to navigate a repricing without becoming its casualty. What we are witnessing is not a trade. It is a transition. Markets do not fail all at once. They strain, distort, and then reprice in ways that reward preparation and punish assumption. Silver is simply the lens through which this broader shift is becoming visible. The central lesson is straightforward. Paper price is not value when availability is constrained. Screens reflect confidence, not certainty. When sovereign actions, inventory behavior, and investor psychology align, the outcome is no longer optional. Repricing becomes inevitable. The first strategic rule is patience. Volatility will increase as leverage unwinds and narratives collide. Sharp drops may still occur, but they do not invalidate the structure. They reflect resistance from a system losing control. Reacting emotionally during these moments is how opportunity is surrendered. The second rule is ownership clarity. Understand what you hold and why. Exposure is not possession. Claims are not custody. In a repricing event, assets that depend on trust perform differently than assets that depend on scarcity. The third rule is perspective. This is not about predicting exact numbers. It is about recognizing direction and duration. Structural imbalances resolve over time, not overnight. Those who focus on noise miss the shift beneath it. History shows that wealth transfers occur when perception lags reality. When that gap closes, it closes quickly. The purpose of analysis is not to create fear, but to remove surprise. If this series helped you see the market more clearly, take a moment to support the channel. Subscribe, share this with someone who needs context, and leave a comment with your thoughts. Engagement helps this analysis reach those still relying on the screen alone. The great repricing does not announce itself. It reveals itself to those paying attention.